Welcome to today's webinar with Sainsbury's PLC, hosted by ShareSoc and Yellowstone Advisory.
I would now like to introduce James Collins, Director of Investor Relations at Sainsbury's. Over to you, James.
Thank you very much, Corinne, and thank you for joining us, everybody, this afternoon. I really appreciate the time that you're giving us. So what I'll do today is I will run through, firstly, just a very brief introduction to Sainsbury's, who, for those who aren't terribly familiar with exactly what we do, and then run through a little bit of context for sort of where we are, recent results, and how we're feeling about the industry backdrop, and where we sit within that, particularly relative to the strategy that we laid out in November last year, so sort of 1 year on from our relatively new CEO setting out that strategy. So moving on to the first slide, so a little bit of background on Sainsbury's. So obviously people know what we do, but just a bit of background. So we have about 600 supermarkets all in the UK, around about 800 convenience stores. 3.6 billion of our grocery sales are online, and that compares to a headline grocery number of about 21 billion. So last year that was, I think, 17% of sales, and the convenience business, a slightly smaller proportion of that. Argos, you'll be familiar with as a business. We have around about 1,000 points of presence. Increasingly, the business is moving those points of presence, so those kind of store points, if you like, to points within Sainsbury's stores rather than standalone. And that's a big transformation program that's well underway now. And as of last year, so all of these numbers are at the end of last year, around about 90% of sales are online. That's now around about 80%, given some normalisation post the COVID pandemic. And we are the third most visited e-commerce website in the UK after Amazon and eBay. Nectar is our loyalty program. 18 million members. It's a coalition program with a lot of other places that people can both collect and spend their points. And we importantly, at the end of last year, had 7.4 million digital collectors. So these are people who have registered for the Nectar app. That's very important in terms of our ability to personalise our contact with those customers, and that's a very important development for the industry. Sainsbury's Bank, you will be familiar with, which is a bank that offers credit both to Argos customers to aid purchases, but also offers loans, savings, and credit cards to customers, as well as insurance and ATMs and travel money. And then two is our clothing business, so sold online and also in Sainsbury's stores. It's now the 6th largest UK clothing business by volume, so a very substantial business, and we've grown online substantially with that. And then Habitat is a brand that came into our business alongside Argos when we bought Home Retail Group, and that's increasingly having more and more of a role in the home and furniture ranges for us online with Argos and in our stores through Sainsbury's. So that's the overview, and then just very briefly on the next slide, how does that translate into the numbers? So we won't really focus on last year's operating numbers. It's more important in terms of where we are right now. But you can just see the mix. So grocery, clearly the bulk of sales. We have a big fuel business as well, and then general merchandise. The majority of that sits within the Argos business. So that's the brief breakdown of the business. So if we can move forward. And we recently reported on November the 4th, we reported results for the 28 weeks to the 18th of September. So that runs March through September. And important thing to say is it's a first full period where we've annualized against the impact of COVID last year. So effectively for us, the 20 to 21 financial year, so March 20 to March 2021, was fully impacted by trading through COVID conditions. And this first half, it was fully up against that. So March to September of this year. So what you can see is that grocery sales continue to rise. Despite clearly some normalization, more people eating out of the home and kind of going back into workplaces, etc., grocery sales still rising year on year. And so if you look on a 2-year basis, so i.e. back on pre-pandemic levels, grocery sales still very elevated at 9% higher. That's clearly the case for the whole of the industry, and we're taking share within the industry as well. General merchandise and clothing inevitably much more volatile. So Argos was in a real sweet spot last year in terms of being one of the few businesses that was able to fulfill and people were able to click and collect orders in Sainsbury's stores, which were open through the pandemic. That put us in a really strong position. Against that, and against some very, very strong demand in seasonal categories and in sort of home working and these kind of things, our sales declined in the first half year on year. That's exactly what we expected. Again, on a 2-year basis, up versus pre-pandemic levels. And then clothing sales really fell off dramatically during COVID trading periods where people were just focused on doing their grocery shopping in stores. So against that very weak period, a strong bounce back this year, but we are up also on a year on 2-year basis. So a really good performance and again, taking market share. So overall, that means our sales were broadly flat. If you take the overall mix of that on a 1-year basis, up 7% on a 2-year basis. If you then take into account fuel, which again rebounded very dramatically from last year where people weren't traveling, Inc. fuel, our sales were up 6%. So that's the top line of the business. Moving on to what happened profit-wise. Retail profit, clearly the most significant part of the business for us. So £523 million of profit. That was up 20% on the pre-pandemic levels, which really is the most meaningful comparison. Last year was complicated by business rates, where in the first half we assumed that we were not paying business rates. That's the kind of grey versus black bar that you can see there. But on all levels, underlying, showing really good progress, representing both the strength of sales, but also good progress on cost savings. On financial services versus last year, where we took a very big impairment on assumed losses relating to COVID, we've seen a bounce back to much more normalised levels of a £19 million profit. If you put all of that together with the fact that we're paying less interest as we pay down debt, that led to, on a 2-year basis, underlying profit before tax up 56% year on year. So clearly a strong level. We also booked some exceptional profits this year. So on a statutory basis, our profit was higher than that at 541 million. And those principally related to a couple of legal cases that we won, as well as some property profits. So moving on. From cash and net debt point of view, we're in a really strong position. So very strong retail free cash flow. It was exceptionally strong last year, driven by the pandemic trading. Still strong this year. We always have a strong seasonal first half, where the stock position means that we carry less stock at this time of year, and the kind of payments mean that kind of flatters our position. And on a working capital basis, you can see that despite the fact we're into normalisation of trading, we still landed a positive number. So that means the net debt reduction was flattered. So we were showing effectively very little net debt at the half year end. You will see some reversal of that. So we will get back to a position of slightly higher net debt for the year end, but underlying making very good progress. And we paid a stable dividend year on year, and that's clearly a key part of us and our commitment to our shareholders. Moving on to the balance sheet. So you can see we've made really strong progress paying down debt. This is excluding lease liabilities, so on a kind of pre-IFRS 16 basis. And we are very much on track to deliver the targeted 950 million net debt reduction by March 2023. We're actually comfortably ahead of that target, driven by a couple of things. Number one, we had a convertible this year that converted, which took around about £240 million of debt and converted it into equity. So that clearly is in addition to the 950 million target. And then second, those legal cases that we won, that will add about another 90 million of cash into the business. So as well as that 950 million, you've got the benefits of those two. So very much on track in terms of reducing the leverage for the business. So then what I'd like you to do, is give a little bit of context in terms of where we are within the market at the moment, what's happening post-COVID. So if you look at the first slide here, I think a lot of questions that we face from investors right now is what has really changed in terms of the way that people shop, in terms of people spending more time at home, spending less on food outside of the home, and spending more online. And the answer right now is we don't know. We don't know the final answer. And the key reason for that is that you are seeing a very gradual normalization. Customers clearly don't act uniformly. So people are gradually becoming more comfortable, returning to stores where people were clearly more cautious during the periods of heightened COVID anxiety. And you can see that. So people are visiting more frequently, hence the basket size reduces and the transactions increase. But if you look at that 21-22 versus 19-20, you can still see that we're in a place of elevated basket size, fewer transactions. And so that's what's happening in our stores at the moment, alongside elevated online grocery sales. So we would continue to expect that to normalise as hopefully the pandemic becomes less significant in driving customer behaviour. Looking to the next slide, please. What, however, we are very confident has changed for good is the role of digital in the way that people shop. Now, so historically, we saw that people really only changed their behaviour as they perhaps went through a life stage where perhaps they had a child, got married, moved into a house for the first time. That tended to prompt a change in behaviour, for example, becoming an online shopper. But what we do know through the pandemic is that a lot of people have started shopping online and then have persisted for long enough that it becomes habitual. So if you look, for example, at the second block here, so pre-pandemic, so in 1920, so online was 8% of our grocery sales. During the pandemic last year, in the first half, it was 15%. It clearly rose and rose over the course of the year as we added more capacity. And in the first half of this year, it's at 17%. It's normalising, so the exit rate is probably somewhere closer to 15%. But what we're confident of is that it will remain much closer to that kind of level rather than return to being around about 8% of sales. Likewise with Argos, so digital participation, so this is where people are ordering online before they go and click and collect or have an item delivered. That was around about 60% of sales pre-pandemic, 90% at peak. Now it's around about 80%. So again, that's a real shift where that's become very much the norm, and that's a good thing for our business in terms of the efficiency of stock. We know what people want. We know because they've ordered it in order to pick it up in our store typically before it arrives. And then Smart Shop is basically the handheld units that you can use in our supermarkets to scan your shopping as you go around the store rather than have it scanned at the till at the end of your shop. It's efficient for customers because it means that you don't need to unpack your shopping and pack it at the end. It's very efficient for us because it reduces the cost of the transactions. And also customers find it helpful because they can track their spending as they go. And so that is now has kind of remained high. It's around about 30% of sales in stores that have Smart Shop units. And then Nectar, so digital, as I said, so these are the people who use the Nectar app. That's rising. We're aiming towards a target of 10 million customers, and that will make us far and away the biggest kind of digital loyalty scheme in the UK. We're already the biggest with around about 8.2 million. So digital, a huge part of what we've done, and I would stress that this hasn't come about overnight. This has come about because we prepared, put in a lot of infrastructure, a lot of technical development ahead of the pandemic, and it's meant that we've been able to really capitalise on that. So we can have the next slide, please. And again, summarising, the year for us, this is a complex chart, but the orange bars, effectively what they show is that we grew our volumes in grocery ahead of the market, both over the 2 years, so over the entirety of the pandemic period that we've covered so far, and also on a 1-year basis. And so, we've grown ahead of the market, but also grown ahead of our key competitors, and that has been very much been driven by the food first strategy that we talked about last year. Next slide, please. And this is a very good representation of that. So customer satisfaction is something that we watch, really, really closely. And beneath these sort of headline numbers of overall customer satisfaction, we have a huge granularity of data on availability, on the quality of our products, the speed of service, all these kind of things. And it's something that we measure, by store, by day, time after time. So we watch it and we react to what it tells us. Now, the really interesting thing here, you'll see a very big, significant step down for us in Q2. And what was that about? Well, clearly we've been in a position where we've been performing ahead of our big box competitors. And availability was a huge challenge across all of the industry towards the tail end of the summer. So you will have read plenty about HGV drivers, about labour challenges across a lot of our suppliers, and that really hit home with kind of particular issues on bread and milk over the course of the summer. So so the drop off in customer satisfaction is effectively because you will struggle to maintain a high level of satisfaction. If a customer can't get bread or milk, it really doesn't matter what else they think of the store, you have effectively failed that customer. And so this is something which clearly was a very big challenge for us coming back up from those very high levels of customer service. Satisfyingly, you can see that we are recovering that, so kind of re-establishing a very significant lead versus the industry. How have we done that? So basically by being very reactive to a lot of the challenges that are out there. The most significant way to describe what we're doing is that we are effectively going and collecting a lot of stock from our customers who are unable to deliver right now. So it's one where we can really put our scale to advantage and use some of the significant supply network we have to solve some of those solutions. So we're satisfied that we have recovered that situation. Clearly still challenges out there in terms of availability, but we've been very flexible, very agile, put plans in place. And again, online, you've seen the same dip and a recovery. And we're really pleased, actually, if we can track the numbers beyond this in terms of where our online customer satisfaction is happening, where it's trending right now. So going back to the plan that we laid out in November, these are the key priorities we talked about. So food first. So it seems obvious for a business like Sainsbury's, which is a supermarket, but I think as a business, we had become over complex at times. So very kind of clear priority to kind of make food the absolute focus of the business. Brands that deliver, so i.e. Argos to Nectar, supporting the food business primarily, but making sure that there's a real good focus on profits and returns, and safe to invest. So effectively raising our ambition in terms of how much cost we take out of the business to put back into the proposition for customers. So those are the top three, and clearly from a kind of digital and data perspective, connected to customers, plan for better. Increasingly important to our customers is what's the footprint of the way that we operate as a business and what they're consuming. And that's something that's very much embedded within the whole way that we operate as a business now. So those are the priorities we laid out. In terms of the metrics that we are consistently promising that we will report on, what's really important to us, so from an operational point of view, grocery market share performance, so we're in a really good place on that. Customer satisfaction, you can see we're clearly in a strong place, but could improve. Colleague engagement, very, very vital in terms of making sure that customers are motivated, happy. That's the best way you'll deliver customer service. So it's something we track and monitor all the time. And we're in a relatively good place on that, could do better. And then plan for better, a lot of commitments around plastics, around carbon, around our scope 1, 2 and 3 commitments. I don't think we can ever tick this green at this stage. There's a lot to deliver over time. And financially, delivering profit growth, reducing our cost of sales, so the operating costs we talked about, and delivering really dependable retail free cash flow. And so that free cash flow is critical, firstly for kind of reducing our leverage, and secondly for being able to deliver that consistent dividend. And all of this alongside that capital discipline should be delivering improved returns. So those are the key metrics we talk about. And moving on, please. So going back to those priorities and food first, kind of three key parts of what we talk about. So value, innovation, and kind of service, kind of principally focused right now on how we develop online. So the way that we are delivering better value to customers, firstly is a consistent promise on a number of items that we will lock prices at a low level. Secondly is in focusing our investment. So where we are saving money, it's focusing the investment on lines where we reduce the prices, and they are on products that really matter to customers. So really high volume lines, particularly around the centre of the plate, around meat, fish, poultry, and also on produce, where again we have a fantastic reputation for quality. We need to make sure that we match that with great value, and that is what the Sainsbury's Quality Aldi Price Match commitment is delivering as well. In terms of how that's transacting for customers, you can see, so we're reducing our prices versus Aldi. So over the course of this period versus last year, we've improved versus 4% versus Aldi. On the centre of the plate, we've improved by around about 2.5%. On those key items versus Tesco, broadly flat overall. And that is really being noticed by competitors. And so if you look at the next slide, this is what we see in terms of the way that customers are behaving. So we're investing in price. We get some response in terms of higher volumes, but still that's a net price investment. But critical to this is the fact that we know that if we get it right on the key products for customers, so on those kind of key meat, fish, poultry items in particular, that customers will shop more of the rest of the store with us. And so we always knew that we had an opportunity in what we call secondary customers, so people who spend a small amount with us, but not a huge amount. And what we know now is that we are growing our spend in those secondary customers ahead of the rest of the market. And that's a real proof point to the fact that we are extracting more spend from customers because we are delivering for them on the items that really matter. Moving on to innovation. So Sainsbury's as a brand has a fantastic reputation for quality, service, and historically for innovation, but we've not been delivering. It was something we knew that we could do more on. And this year we have committed to tripling our rate of innovation. So rather than 600 new products that we delivered in the base year 1920, we will deliver 1,800 products this year. And so this is an example, autumn editions, where we're delivering innovation, and we're delivering it in very big launches which customers really notice. And so autumn is a great example. We've never launched an autumn range before, but it really tapped into customers' kind of desire for as the season changes, for different kind of range, tapping into sort of warmth and again different flavours. And that was a great example of fantastic customer response. And then the third part of the key focus on food is on service, and just focusing on online here. So we've committed that we have the flexibility to be able to service online demand. So the key achievement here was that we took online orders. We were doing around about 300,000 at the start of the pandemic so around about 340,000 in March 2020. We peaked at around about 860,000 orders at the tail end of last year. Now that's clearly normalised at a level we're currently doing around about 650,000 orders a week. But really critically, what we've managed to do and what we will continue to do is improve the efficiency of that. So we got a scale benefit as the business got bigger. as basket sizes improved, and we were able to drop or basically to deliver our orders more efficiently with more drops per hour in a more concentrated area. And we've continued to make progress on the biggest cost of that operation, which is the item picking. So i.e. Online shoppers or online staff in our stores picking orders for customers, that continues to move forward. So not only are we maintaining a very, very good market share in online, we're delivering that really efficiently. So the profitability of that is significantly improved versus historic levels. Moving on, please. Nectar, talked about that earlier. It's a really key part of how we communicate with our customers. Nectar Prices is something that we recently introduced in September, where we are delivering personalised offers to customers through the Nectar app and through Smart Shop. That's something that you will see grow over time. It's potentially very, very exciting in terms of our ability to deliver really meaningful value to customers on the products and type of products that really matter to them. So it's a huge development. It's something that we are pretty unique, certainly in Europe, in being able to do, and it's something that you will see grow over time. And then Argos clearly had a fantastic pandemic in terms of the top line of the business. And this left-hand chart you see on fulfillment shows how much the business has changed. So historically, quite a mix between customers walking in, choosing products, taking them away, reserving products, paying for them in store, moving away. We've basically become now almost entirely an online business where people are ordering online for home delivery, ordering online to pick and collect in store, with kind of very little walk-in trade. That's very efficient for us and for customers, frankly, who've become more and more used to this way of shopping. So very much an online business now. The right-hand chart is a complex chart, but basically what it shows is where we were incredibly strong on a one-year basis last year in some of those categories that were very, very strong through a really good summer, where seasonal was very strong, where consumer electronics saw huge growth as more people spent more time in their homes during the pandemic and particularly home office. Inevitably, you've seen some normalisation of that year on year. And we've also de-emphasised some categories. So toys, as we become less promotional as a business, which is key to part of our kind of transformation and improving profitability, some categories we're choosing to sacrifice sales that frankly were not particularly profitable. And looking at the transformation, so I talked earlier on about the fact that we had 1,000 points of presence at the tail end of last year. We now have fewer points of presence, and you can see that our plans are to reduce the amount of standalone Argos stores, moving more of those into Sainsbury's. Clearly, that's a significant cost saving for us. And frankly, it's more convenient for customers because Sainsbury's stores are open longer, free car parking, and with customers being able to order online, it also means that that we reduce the amount of stock within the business. And over time, the Argos proposition will continue to improve as we build a network of local fulfillment centres. So at the moment, Argos stock is held within Argos stores and distributed on a kind of hub and spoke basis. As we build local fulfillment centres, all of our stock will move into 32 centralised centres. That means that more stock will be available faster to customers. Availability will be significantly improved. And then moving on to cost savings, talked about this, it's a vital part of what we're doing. So we talked about raising our ambition on cost savings. If we were to criticise ourselves historically, we've been very good at delivering cost savings, but we've equally managed to deliver those cost savings, but we've also let other costs in the business rise too high. So good levels of overall cost savings, but the line you can see shows that our cost as a percentage of sales has basically been pretty stubborn. It's risen, been broadly flat to rising over time. It's a very, very different commitment and ambition for us to reduce our operating cost of sales by 200 basis points. That provides the fuel for us to reinvest in the business, provide better value, provide better service, offset some of the kind of the challenges in terms of cost inflation, and also deliver to shareholders in terms of improved profitability. So it's a really vital part of what we're doing. Clearly some real challenges in doing that right now. So we're all aware that inflation is rising, labour costs are rising, particularly in parts of the supply chain. And so we've raised our ambition and still very much on target to meet that 200 basis points target. And what does that mean overall? So what we committed in November to delivering is profit inflection. So if you consider that cost reduction, you consider working with suppliers to help fund some of the investment we're making, that will all deliver a better food performance. And so profit inflection is vital. So versus the base profitability in 1920, a normalised year, we made 587 million of underlying profit. And we are saying that we'll be making at least 660 million this year. So definitely delivering on that profit inflection. High returning capital projects, so real capital discipline. So historically, the industry, I think, has spent too much money on refurbishing stores, building new stores. There's real capital discipline across the industry now, and we are particularly sharp on this in terms of our commitments, and where we are doing big transformation projects, we are very clear that they are delivering very fast returns. So we are platforming all of our logistics and infrastructure, where we're bringing the Argos and Sainsbury's platforms together, but that is delivering a very substantial cost reduction relative to the amount that we're investing. And likewise, where we're transforming Argos with this move to have fewer standalone stores, more local fulfillment centres, again, a very, very high return. And so what does that mean? It means we're really confident in terms of the free cash flow generation of the business. So by the end of this year, we will have delivered an average of £500 million average free cash flow for the last 3 years, and we're committing to deliver more than that again over the next 3 years, so 23 through 25. We're well ahead in terms of net debt reduction, as I pointed out earlier, and all of that means that we will be able to very comfortably cover a very sustainable dividend, which should rise if we deliver on our plans to deliver that inflection in profits. So I think that summarises my hopefully a good view of kind of where we are as a business, and now I will happily take any questions.
Brilliant. Thank you very much for that presentation, James. And as you say, we're now going to take questions. It's interesting, isn't it, how customer behaviour is changing and how Sainsbury's is adapting to that. Look, just as a reminder, if you want to ask a question, there's a Q&A box at the bottom of your screen. Please type your question in there. There's also a facility to upvote or downvote any of those questions. I'm going to try and get through as many questions as we can. We're going to start, actually, we had 2 questions in ahead of time, so I'm just going to start with those, and then we'll go to the most popular questions that have come in today. So, James, firstly, how much of your property portfolio is freehold and how much is leasehold? And are there any plans to change the mix between freehold and leasehold properties?
Yeah, that's a good question. It was one that got a lot of attention, particularly after the Morrisons deal, given the higher proportion of freehold that they have. So it's roughly 50-50 for us. So 50% freehold, 50% leasehold. If you look at our supermarkets, which clearly is where the vast majority of our property value sits, we own roughly 60% of our supermarkets, our big supermarkets. And that's diluted down to 50-50 by the fact that we own very few of our convenience stores, so they are almost entirely leasehold. And then likewise with the Argos stores, they are also leasehold. But on a supermarket basis, roughly 60%. We don't have a target in terms of whether that's going to increase or reduce. We are very flexible. And in a lot of circumstances, so we are occasionally buying in some freeholds from third parties that we currently lease from. Typically, we would do that if we think that there is a good deal to be had, and or we think that there's very good development potential on those sites. So we do have an advantaged portfolio in that we are biased towards the south and the southeast. So and with a very good portfolio in London as well. And so a lot of our sites do have value over and above the value that exists in retailing as a grocer. And we are gradually exploiting that with a number of what we call mixed-use developments. So if for example, we're currently doing one in Ladbroke Grove in London. We did one in Nine Elms, where we will take our site and, working with a developer, we will rebuild a new Sainsbury's store, but also build housing and release a lot of value from those sites. So a lot of value that sits within our property portfolio.
Okay, thank you. And another question here. How does the profitability of stores compare to the profitability of online? And how big as percentage of overall sales could online get in the grocery division?
Yes, it's a great question, and again one that's very high up the agenda as we talk to investors right now. So online grocery, so pre-pandemic, online grocery was about 7 or 8% of our grocery sales. It peaks at around about 20%, and we're now, as I said, now the exit rate of the first half was around about 15%. But we think it'll kind of remain at those sort of levels before probably steadily rising again. And I think the rise will be steady, and as it tends to be generational shift, that as people who are more online savvy become kind of more family shoppers, they tend to kind of shift more of their spend to online, and they become bigger grocery shoppers. So we expect it to rise. We do think that it will be more than 20% of the market over time. In terms of the profitability, right now it's undoubted. It is more profitable for us if a customer walks in to our store, selects the items themselves, and it goes through the checkout and walks out. So that is the most profitable channel for us right now. However, the economics are not that simple, because aside from anything else, the average basket in store in a supermarket is a little bit above £20. The average basket online is close to £100. And so if you then think about the relative cost allocations of those, actually it's a lot of gross margin, it's a lot of gross profit that we're delivering in each online grocery order. But overall, the kind of key way to think about online profitability and what it's doing for our business is that right now we deliver or we fulfill all of our online grocery orders through our stores. So right now the fact is we are doing grocery sales in the first half 7% higher than they were 2 years ago. All of that's going through our stores. So on that very big fixed cost, you're getting very, very good leverage. Now, there will be incremental costs of that with online, but equally, if you can make sure that you're more efficient in store, so you're recognizing the fact that fewer transactions are going through stores, more are being done on Smart Shop, more are being done on automated tills, you take cost out of that channel as well. So it's not simply a question of diluting with lower online profitability, it's managing the overall costs in the box, in the store, to deliver that profitability. So I think, again, sometimes it's seen simplistically as just being a dilutive business for us, but key to that is that we are getting more leverage through the overall platform and the kind of very substantial costs that sit behind our stores.
Okay, thank you. We're now going to ask a question on inflation. To what extent do you expect your margins and profits to be reduced by recent and near-term inflation?
Yeah, so there are two aspects of inflation that we need to think about in those terms. So number one is cost of goods, so i.e. the cost of raw materials feeding through to higher costs. So be it wheat feeding through to bread, be it higher labour costs feeding through to kind of more processing costs in meat, etc. And there is undoubtedly more pressure on our cost of goods than we've seen for a number of years, and you will have seen that in a lot of the statements that you're seeing from the manufacturers as well as the retailers. I think our central expectation on those is that the industry, I think in a disciplined way, will pass those on. There is nobody in the industry who makes sufficiently wide margins, that they can afford to absorb those. And additionally, the history of the industry would suggest that taking a different position and seeking to kind of establish a different price position rarely pays, because the rest of the industry responds. So we do expect a relatively disciplined pass on. But what we do know as well is that we are in a stronger value position going into that than we've ever been in. So we're absolutely determined that we won't be the first people to pass on. We'll make sure that we're very competitive. It's not straightforward. Everyone in the industry watches what everybody else does on different categories to make sure that everyone's competitive. But so we don't really expect significant margin pressure from that. The second aspect of inflation right now is on our operating costs, and there are the most significant part of that sits in logistics and supply chain and HGV drivers, of which again I'm sure you've seen plenty of coverage. Some of that is one-off in nature. So in order to make sure that we are able to get good supply, help our suppliers out by collecting items, and also deliver online for customers, we are upping our payments to some of our drivers, and particularly paying one-off retention payments. So that will be a feature certainly for our peak period in the second half of this year. And realistically, that will feed through to higher ongoing wages next year. So as we look at those cost-saving targets we have in this reduction in cost of sales, it's one of the key things that we have had to increase our ambition for cost savings to offset some of that underlying inflation. So undoubtedly a pressure that we hadn't anticipated to this degree, perhaps earlier in the year, but one which we are confident that we can rise to.
Okay, thank you. Could you comment about the work Sainsbury's is doing under the Sainsbury's Global Farm Initiative?
Sorry, I didn't hear that one.
Could you comment about the work Sainsbury's is doing under the Sainsbury's Global Farm Initiative?
Yeah. So if you firstly, a shameless plug. If you go to our website, you will see that we in June of this year laid out our ESG strategy. So we talked about our environmental sustainable governance goals, particularly around sustainability. So you will find a huge amount of information on our priorities in that area on our website, a lot of presentations, a lot of detail, and our targets in that area. One part of that and kind of embedding all of that into our core business has been our kind of new marketing message, which is help everyone eat better. And part of helping everyone eat better is not just about kind of healthier food, but it's also about helping everyone eat sustainably, help everyone eat in a way which has less impact on the environment. And the Global Farm Initiative is working with LEAF, which is the body which links environment and farming, and that helps provide educational resources to help people learn about sustainable farming. And so, in all of this, in all of the kind of goals that we have to reduce our impact on the environment, collaboration is absolutely the way to work. We can't sit here and expect our suppliers to just transform the way that they operate, and we can't expect to transform the way that our customers transact and behave, unless we do things as an industry and we do things alongside our suppliers. So if you again, in terms of detail, you can look at a website. So there's a website called sainsburysglobalfarm.com, and through the collaboration with LEAF, that gives a lot of information about farmers, where we are, where our food's coming from, and what we're doing on sustainable farming.
Okay, I'm going to ask two related sort of ESG type questions here. One is, please could you outline your approach to carbon footprint reduction? Examples, EV delivery vehicles versus diesel, fruit from Peru, etc. And also, are you planning to install solar panels in your buildings? And what's the plan for this, please?
Yeah, so actually we were trying to verify this earlier in the year, but we certainly at one stage were the biggest operator of solar panels in Europe. because we had moved very early to put solar panels on the vast majority of our available space, i.e. on the roofs of stores and distribution facilities. So, so we have solar panels on around about half of our stores. That's around about 41 megawatts worth of energy per year. And we have ambitions to go further. And a lot of that, it's not, clearly these things are not as simple as you would hope. So a lot of it will be kind of reformatting a roof, reformatting a store in order to be able to accommodate that. So that is ongoing work. And it's a great example of, a lot of the time I think we're asked about what's the conflict between operating in a sustainable way or operating in a way that delivers returns. That will be a great example alongside something like LED lighting, where we will invest and we will invest where we know that we're not going to get a return as we might in other areas of the business, but we get a guaranteed return. So we know that over time that will pay back, and also we're delivering on our commitments. So that would be a great example. In terms of reducing our carbon footprint, the fact is that we're doing a huge amount of work around this. We know that the global food supply chain accounts for around about a third of carbon emissions. So it is a huge goal as an industry and a huge part of what the world can do in terms of reducing the carbon footprint. So we are working most vitally with our suppliers. So whatever we can do as a business in terms of, to your point, we're working on so many initiatives around reducing the energy consumption of our fridges, reducing the amount of heat wasted in our stores, working with manufacturers to try and develop a kind of feasible solutions for distribution with electric vehicles in terms of our kind of overall logistics, and also on our online vehicles. And at the moment, again, this is a great example where right now there is no solution to that, but only by working alongside academic bodies, alongside manufacturers, engineering experts, will we deliver that. So, so a huge amount of work going on there, but far and away the biggest carbon footprint that exists is in our scope 3, and that is where we work with our suppliers to look to them to see how do we reduce, or how do we help them reduce the footprint of their production. And so a great example would be soy, for example, where the amount of soy that is consumed by, for example, poultry that we sell in our stores, it has a very significant carbon footprint. If we can work, and we are working with our suppliers to reduce the amount of soy that they produce, that they consume, so perhaps with alternative feeds, and also looking at initiatives where you can reduce the actual consumption or carbon emissions associated with soy, then those will go a huge way towards making a bigger degree of progress than we can make alone.
Okay, thank you. And just one linked question to this: how does your fuel strategy fit into the, I guess, the move to EVs, and how will that affect your opportunities there?
Yeah, so it's a really good question, and we will definitely have more to say on this next year, because there are two aspects to this. Number one is our fuel business and what happens as there is lower fuel consumption in the UK. So as there are fewer digital and petrol vehicles, the reality is that as much as no new digital and petrol vehicles will be sold by 2030, there will still be a big tail of demand, so it won't kind of fall off the cliff. And we think the market will consolidate. So we still think we'll be in a relatively strong position as one of the bigger retailers. So we're not expecting significant de-gearing of that business, if you like. But alongside that, there is undoubtedly an opportunity in terms of EV charging. And I think, again, sometimes we're asked, does that mean that your petrol filling stations will be switching over to EV charging points? But filling stations are not the right place for EV charging points. But we do have car parks, clearly very conveniently located, quite often with excess capacity, given the amount of grocery that's now going online. And so both in terms of being able to be a centre for rapid charging, and also potentially for customers, and also potentially rapid charging for our own vehicles, that's really quite an exciting opportunity. But again, it's not one where it's just a question of plugging into the existing power supply. You need kind of very significant development. So it's something which we are doing some significant work on, and we'll be talking more about that next year.
Brilliant, great. How do you think the market will be affected by Morrisons joining Asda in being taken private?
Yeah, it's a good question. So I think that the wrong answer is for us to assume that because these businesses are now more heavily leveraged, and that therefore they have kind of different financial goals. I think so. So I said the wrong answer is to assume that will mean that therefore they are less competitive businesses. I think that's a naive assumption, because the reality is that it is a very, very competitive industry that we operate in. I think the idea that they sit back, kind of take more profit, and that's the way that they deliver the cash that they require, I think is wrong, and we certainly wouldn't rely on that. I think if we stand back and say, well, why has private equity got involved in the UK grocery industry? And perhaps similarly, why has the equity markets recognised that businesses like ours were undervalued, and hence the kind of strong share performance that we've had over the last couple of years? I think it's because the financial markets, be it private equity, be it the open equity markets, are recognising that the industry is in a far better place in terms of capital discipline, where the industry used to put down too much new space, spend too much capital, not have good cash generation, and the supply-demand balance was not good for the industry. So I think that's where the private equity financial backers are starting to recognise that actually there are very good sustainable cash flows to be had from these businesses without need for kind of aggressive financial engineering. So we are very good generators of cash overall. And so I think that you won't see anything that radically alters that for those businesses. And we're certainly not relying on them becoming less competitive businesses.
Okay, thank you. Flipping back to the online business now. At the moment, online sales or orders are picked in store, which is relatively costly and inefficient. When will you make the investments to have the efficient warehouses with robots, a bit like Ocado are developing, so that margins can increase substantially for the online business?
Sure, good question. So right now, we have a fantastic network of, like I say, 600 supermarkets, of which we pick online orders from about half, a little under 300, and also 800 convenience stores, of which we are now picking an increasing number of rapid delivery orders. So where customers are ordering through Deliveroo or through Uber Eats, or also through our own Chop Chop service. And the fantastic benefit that they have, which a centralised warehouse doesn't have, is that they are close to customers. They're close to customers, they have a volume stock already going through them, and they do not require any incremental capital investment on our part. So for us to be able to start picking in a store is very limited incremental capital. So I think as a consequence, I think a lot would need to change before we would decide that a centralised solution is the right answer for us. And our stores are very flexible, ultimately, because if you consider that right now we have a certain proportion, 80% of sales that go through the front of the store, sometimes 20% or 20% more that go through the back of the store. As that changes over time, it's our space. We can shift the back of the store. We can make it more efficient for picking. So we have the flexibility to be able to do that. Over time, what will change? Well, labour costs will continue to rise. The technology that's available in either centralised picking solutions or in having some form of picking solutions available in the back of our store, so kind of robotics on a smaller scale to pick orders from the back of the store, I think that technology will improve and reduce in cost. So you will get a crossover point at which it will make sense for us to start investing in some of those solutions. But it won't be a kind of transformation of scale. So we won't replace everything overnight, and it won't work in all areas. And so particularly as immediacy builds, as that cost equation changes, we will have more automation, but that's likely, I think, to be focused on our stores rather than big capital investment on which, we have clearly run all the numbers, and we'd be confident right now that we would not get a return.
Brilliant. We've got time for one last question here. How is your performance versus Ocado, and why are they not on your comparison slides?
Firstly, in terms of our overall performance, if you care to go to our investor relations website, you'll see a much bigger depth than I put in front of you today. So if you look at market share, actually, thanks, Susie's just shared that. So you can see what's happened in terms of our online market share over the last few years. So we've gone from 18-19, so the pre-pandemic base, 15.5% market share, to 21.3, so gaining 6 points of market share. Over that period, Ocado's gone from 17.5 to 14.5. Aside from anything else, this shows you the flexibility that we've had in terms of being our ability to add capacity. Clearly, Ocado's a centralised model has lacked that flexibility. So we've been fantastic in terms of our market share performance, far and away the strongest of anybody in the market. Again, if you look at Tesco, gone from just under 38 to 35. So delivering fantastic market share performance. Where we know that that Ocado delivers a better customer experience is range. So this is something where on a centralised model, you can carry a lot more range and a lot more tail of products that turn less frequently than we would necessarily carry in store. So that is one thing which, again, as we look to solutions which might have more picking in the back of the store, that's one thing that we would look to enhance for customers. So when we look at the customer satisfaction metrics, we know that Ocado scores well on service and it scores well on range. But as I say, if you look at the overall performance, our market share has been very, very strong in online.
Brilliant, James. That brings us towards the end of today's webinar. Thank you very much for presenting so clearly and for answering all those questions that came through. We apologise if we didn't get a chance to answer all those questions, but I'm afraid we've just run out of time. Just a reminder, as you leave today's webinar, you'll be asked to complete a feedback form. It'd be really appreciated if you could just spend a couple of minutes completing that form. And also just a note that we've got a couple of upcoming events that ShareSoc and Yellowstone Advisory are hosting jointly. It's Lloyd's Banking Group on the 7th of December and Halma on the 13th of December. So just leaves me to say thank you again to James and for Sainsbury's for presenting today, and we hope to see you all soon.